All right, our next guest says that the risk reward in equities today isn't as good as it was a year ago. He says investors should expect lower returns and higher volatility. Oh, goody. Here we go with the new year. We want to bring in McKinney for this. He's senior portfolio manager at NFJ Investment Group. Why don't you talk a little bit about this, Burns? Why do you think that this is a riskier year?
Well, basically, one way we're looking at it is that investors had a great 2024 during the fourth quarter of 2023. And, really the one primary mover of markets for the last year has been interest rates. And so when the Fed pivoted, the Jay Powell and company said, maybe we might even cut rates 3 times next year. And what did the market hear? Well, the market heard 6 times. The analogy I sometimes try to picture is, have you ever seen someone walking their dog? It's a big dog and they're getting just pulled along on the leash. Well, that big dog is investor expectations. And the fellow at the end of the leash, that's Jay Powell getting yanked along by animal spirits. And as a result of that big rally, you're looking at U.S. equities trading at about 21, 22 times earnings. That's more expensive than they've been about 75% of the time this millennium. So overall, I think the risk reward isn't as good. That said, breadth is expanding. And so for stock pickers and those who are selective, there definitely are opportunities this year.
All right, let's stick with that analogy. How does the walk end? Most of the time when you see that happening on the streets, the owner eventually gets control and maybe gets a choke collar. Sometimes the owner gets pulled over. What happens?
Or the dog gets run over.
I think one of the things you have to consider is that not so much what are interest rates and what is the Fed going to do this year, but how you might want to get it wrong. I mean, you can have the one type of error where one expects and builds a portfolio expecting 6 cuts, and perhaps you only get 3. Or the flip side, you maybe expect 3 and you end up with 6. The latter type of error is probably the better error that you want to make for your portfolios, whereby we're suggesting clients maybe invest a little bit more conservatively and build a portfolio of names that have visible earnings. And this is a great type of environment to buy companies that are returning capital to shareholders via share repurchases and especially in dividend raises.
You do think, though, that inflation is falling more quickly than data suggests right now. Wouldn't that lead you to think that more cuts are coming more quickly?
Inflation definitely is coming down more rapidly, I think, than even the market has priced in. When you consider that the last 3 months, core inflation is around 2.4%. And really the biggest driver of that has been shelter costs, which, that's stale data. If you look at real-time shelter data and plug that in, inflation may already be at the Fed's target. And so that said, the Fed does have the ability to reduce rates, but there's 2 reasons that the Fed would reduce rates, one of which is on economic weakness, and the other is simply that inflation is coming down. And I think that really the inflation coming down is probably the good reason, whereas the economy is showing signs of maybe softening from 2023's growth, but you're not necessarily seeing signs of recession yet that might necessitate cutting more times.
You like industrials and you like healthcare. Why?
In the case of industrials, it's a sector that really has almost twin secular trend engines, one of which is the infrastructure spending bills that were passed a couple of years ago. That may seem like yesterday's news, but a lot of that money is just going out the door. And that infrastructure spending is expected to double even over the next couple of years, not peaking until 2026. You have that. And then in a world of geopolitical uncertainty, a lot of industrial names reside in the defense space. And so I think that spending is continuing to drive it. And just, we're seeing a gradual rebuilding of U.S. manufacturing capacity, all of which said, more important than anything, industrials don't have demanding valuations. Whereas in the case of healthcare, it's the one sector in which if you have an uncertain world, which it seems like we do today, it's the sector that kind of straddles, is kind of the best of all worlds between playing defense and growth. You have, great demographics. You do have, many of the names in healthcare provide things that are non-discretionary. And so that allows investors to be defensive if we do have an economic slowdown. But at the same time, it's the one sector that's actually generated the best earnings growth of any sector, even including technology, over the last 40 or so years. And so you get the compounding effect of that growth is something that can also drive returns.